it's not going to be a traditional war and sort of a hot traditional war that we're sort of used to. It's more securing a sort of arms race, or you will, a sort of commodity race. 5,000 is the big psychological level in gold. Gold is is universally the consensus bullish call amongst equities, amongst fixed income. So I think that's pretty worrying for me. If you're talking about the fact that we've got US, China, and Russia trying to carve up the world, that is extremely negative for growth.
I'm back with Nicky Shiels. She's the head of research and metal strategy at MKS Pamp. Nicky was last on the show last year in 2025, in April. And since then, much has changed in the commodity space. She's made a number of correct calls. She's called for gold to go higher towards 3,700. Well, it's blown way past that target. We're going to find out what's next for the metals and the global commodities complex with Nicky. Welcome back, Nicky. Good to see you.
Good to see you, David. Thanks for having me back.
So congrats on calling the direction right. Although I think the move towards the end of the year, especially the white metals, silver and platinum, surprised a lot of people, probably yourself as well. We'll talk about that in just a minute. The fact that Donald Trump is so blatantly obvious in what he wants with Venezuela, which is to take the resources, export the oil, get the oil companies into the country to sell the oil. How is that going to affect not just oil, but the rest of the commodities? In fact, which of the commodities that you cover do you think will be most impacted by the takeover of the Trump administration of Venezuela?
Great question. I think what it really speaks to is, and we've spoken about the sort of like underlying strategic theme this whole year, which is the weaponization of commodities, especially critical metals needed in the AI race, critical metals or minerals, including oil. And I think the developments over the weekend just sort of signifies that. Look, I think what it does is it accelerates and it emboldens other countries to do the same, to seize up. So I think we're entering a period where you've got the three strong men, right? You've got the military powers, US, Russia, and China, simply going to carve up the world. And what that is going to inject is a lot of panic, a lot of fear. And I think that's going to accelerate central bank buying in gold. And so, yes, I think it should definitely overflow into some of the other metals, precious metals, and strategic metals. But first and foremost, I think it's very underlying support of gold. For energy, look, it's more of a negative. I think you're going to unleash resources that weren't there in the market. So you sort of have this dichotomy between sort of lower energy prices and sort of a higher metal regime.
People all over the internet are talking about preparing for a third world war. I don't know if that's the case, but the gold market certainly doesn't seem to think that way, because it's hovering still around just below $4,500 an ounce. It hasn't really moved much higher since the events of last week. Is the gold market a good indicator, you think, Nicky, of geopolitical tensions?
I think generally it is. I think you can look at a ton of different sort of fear proxies. You can look at defense stocks. You can look at gold. I think you can look at flows in the market. I mean, I think the talk of World War III. I think it's not going to be a traditional war and sort of a hot traditional war that we're sort of used to. It's more securing a sort of arms race, or you will, a sort of commodity race. And you're seeing that especially in copper, in silver, where you've got sort of these regional strategic stockpiling of metal, and that becomes locked up. And I think, it accelerates higher pricing, it accelerates dislocations across a lot of these commodities, making it harder to trade, and it certainly accelerates the volatility.
The fact that oil, interestingly, hasn't really moved much on this development, what does that signal to you? It's still hovering around $57 a barrel, WTI.
Yeah, it's, I think I think a lot of it is the sequencing of events, right? So you'll get the knee-jerk reaction, and then the market just needs to sort of try to factor in when exactly it is a pretty tough crude to refine. I'm not an oil specialist, but again, it's about the logistics and then figuring out when that does actually come to market, which is probably only 6 to 12 months time down the line. I think oil also is facing sort of these confluence of factors happening across commodities. On the one hand, you have a super supportive macro regime. So that's reflation, that's debasement, that's looking for sort of like inflation hedges. On the other hand, you look at global stockpiles, and which are still pretty, they're decent amongst in energy space and in metals, and demand isn't that great. So I think oil's kind of caught between that the tailwind of sort of a very supportive macro backdrop where you're getting investor inflows, but the fundamentals are pretty negative.
The fact that this is happening on the backdrop of, like you mentioned earlier, the interview, this higher level of restrictions around the world for exporting certain critical minerals. For example, China, all throughout last year, 2025, has placed restrictions on exporting critical minerals like antimony, critical for defense and ammunition production. And now recently, over the new year, they announced they're going to limit the export of silver, which Elon Musk even tweeted about, saying this is a bad thing. It's needed for many industrial processes. And interestingly, again, silver hasn't moved much in the news. So either the markets don't think that this is important for the overall supply of silver, or they don't think this is going to stay. What is your take?
All the markets knew the headline was coming because they seem to have moved beforehand. Look, I think there's a lot of policy changes happening, whether it's on the sort of the critical metal tariff related side of things, or whether it's on the investment side. For example, India has just announced and rejigged their sort of pension scheme, allowing government pension schemes to invest up to 1% in gold and silver ETFs and up to 5% in private funds. And that's a game changer. And you're seeing strong imports into India. You're seeing, ETF, silver ETF in aggregate holdings in India are shooting up. So I think whether it's policy on the investment side or policy sort of more driven around government strategic stockpiling or strategic securing of assets, there's certainly a huge net tailwind coming into sort of just the critical metal, just metals and minerals who have a usage and ones which are scarce, which in turn is driving sort of a lot of your sort of retail or FOMO inflows in the space.
We saw in the past year Trump, Putin, and Xi Jinping fighting a trade war over the key components of the global supply chain. Trump imposed a 50% tariff on copper. China restricted the exports of rare earth minerals in October and recently placed restrictions on silver exports. Last week, the world witnessed Trump's administration taking over Venezuela's oil industry. And importantly, when it comes to rare earth minerals, lithium, uranium, and rarely talked about mineral molybdenum, China commands major leverage over the West. China controls a commanding share of global capacity of lithium refining and processing. It processes 60 to 70% of the world's lithium chemicals, including lithium carbonate and hydroxide. On copper, China imports about 60% of global copper ore and unrefined copper and produces more than 45% of the world's refined copper. Reuters also reported that according to the International Copper Study Group, China consumes about 58% of the world's refined copper. As for molybdenum, China accounts for 42% to 45% of global output. Copper, gold, lithium, uranium, and molybdenum are 5 key minerals that today sponsor Vanguard Mining, ticker symbol UUUFF, on the UX exchanges, has direct exposure to in its diversified portfolio, spanning a number of safe US-friendly jurisdictions. Molybdenum might not make headlines every day, but it's indispensable. It strengthens steel, enables high-temperature alloys, and is critical for pipelines, defense systems, aerospace, and energy infrastructure. Vanguard Mining's projects are located in US-friendly regions, Canada, Paraguay, and Argentina, critical for investors looking to diversify away from geopolitical risks. Their projects are divided between gold, uranium, lithium, and copper molybdenum. Their gold deposit is situated in British Columbia at the Brussels Creek project. They also have a gold, copper, palladium exploration project in the Kamloops mining district. Vanguard Mining's uranium project is substantial. They control over 90,000 hectares in Paraguay's Parana Basin, strategically located right next door to Uranium Energy Corp's world-class UT project. For lithium, Vanguard Mining reclaimed a 100% interest in the Boquitos 1 Lithium's Salar project in Argentina for no additional cost. Do your own research today on this multiple minerals company. Right. Okay, so what do you think will be the major drivers then of silver? Let's start with silver and platinum and the white
Yeah.
metals first into the rest of the year, if not the export restrictions we're just talking about.
Yeah, I think no, I do. I absolutely think. I think it's a macro investment driven
Hmm.
market we're in at the moment. Yes, industrial and the fundamentals do matter, but the inflows on whether it's retail, it's institutional, or sort of more your day traders and your speculators more than offsets the downturn which we're seeing on industrial and on the jewelry sector. I do think both metals have run a little too much too fast. And I think when you do get that turn right now, we've got index rebalancing that is starting today for the next 5 days. Silver, about 15% of aggregate open interest is meant to be sold across futures, which are huge amounts. So I think that's a big test in the very, very short term for silver and for gold. Doesn't affect PGMs as they're not in BCOM or in most of these the indices. The biggest threat to white metals is going to be the ultimate impact of an accelerated, aggressive US foreign policy and on global growth. And already, yes, we so the first half of this year, we do see sort of a reflation macro float up, but we're now talking about a global recession that could be pretty steep if you're talking about the fact that we've got US, China, and Russia trying to carve up the world, which leaves a very squeezed Europe, and that is extremely negative for growth, which I think that certainly the commodity markets or certainly the metals markets are not pricing in.
Is the automotive sector still a driver of platinum? Something that's gone up a lot
Yes,
last
no,
year? Yeah.
absolutely. I think it's been the automotive sector is especially a driver of rhodium and palladium, platinum somewhat as well. Platinum has, it's between jewelry, industrial, and auto. The big news over the last say month or so on the platinum side, there has been a real sort of dial back of the EV narrative. We saw Ford took a pretty large hit to the EV business. The EU has come out and watered down the 2035 ban of ICE vehicles. So now we're talking about, okay, we're not going to get peak EV, perhaps, and there's a shift back into hybrid vehicles, which actually do use PGMs and or ICE. And so I think that's been a big driver into the sort of higher floor regime in PGMs and why you see consumers sort of hedging further out the curve.
Can we talk about your forecast then for all these
Yeah.
metals, starting with, let's say, gold? The fact that gold has been hovering around $4,000 to $4,500, trading range bound in that range for a few months now, Nikki, is it ready
Right.
for a breakout in either direction just yet?
I think, 5,000 is the big psychological level in gold. I do expect gold to take 5,000 probably in the first half of this year. I have a high price of 5,400, which basically is a 30% year on year gain. So yes, really good solid bull gains expected again in gold this year, but not outlandish like we saw last year. So last year I think was sort of a bit of a wild ride, a bit of a cowboy year, but we do expect some very solid gains across gold and the white metals as well. So yes, I basically expect gold to average 4,500 this year. The big risk to gold, which I think we do need to talk about, and people are sort of fearful of that, is the overcrowding risk, right? I think I've gone through a ton of bank research reports, including independent research houses, and from a macro level, gold is universally the consensus bullish call amongst equities, amongst fixed income. So I think that's pretty worrying for me. But as long as you get the central bank backstop, I think it can continue as a sort of wealth diversifier, and it's a secular play, and it's in its early innings.
You mentioned to me last year when you were on the show in April that the fact that the central banks have been buying gold in such large quantities, that has contributed to the price rise. It will increase up until that point. It will contribute all the way up to $3,700. Now that we've blown way past $3,700. Are central banks still a key driver, do you think?
Yes, absolutely. They're the ones keeping higher floors in gold. Just now, China have released their numbers again. Is this a full release or is this just the tip of the iceberg? But what, the Venezuelan developments absolutely accelerates the need for sort of non-Western, a lot of your Asian, and sort of Eastern European central banks to just continue reallocating to gold.
What happens when the Federal Reserve becomes a little bit more dovish than we expect? We're operating now in a backdrop of unexpected geopolitical policies around the world. We don't know exactly what's going to happen, not just with South America, but all around the world, and the ripple effects that this past week's events will have on the Middle East, as well as China and Russia, for example. We don't know what the Federal Reserve is going to do
Yeah.
in response, if at all. We just know that the next Fed chair will be much more dovish than Jerome Powell. How do these factors play into the price of gold?
Well, it's certainly very bullish and supportive. The question is how much is already priced in? Because I think the market really turned probably the last 2 months of last year and already sort of front running the expectation of a very dovish Fed in 2026. And the data sort of needs to come out and support that. You need a kind of Goldilocks slowdown in terms of, there's enough slowdown, but not too much of a slowdown to cause a sort of fear of a V-shaped recession. So yes, I think it's supportive. If they're more dovish than expected, I do think it's relatively more bullish. The white metals like silver and platinum should outperform. If you got relatively stable growth, I mean that's going to drive real rates lower. And I think that's the real outsized risk there.
Well, let's take a look at the charts now, Nikki. So over the last 1 year exactly, gold is up 67%, 65 and change, and silver is up more than more than 150%.
Yeah.
2026, same year, we're not in terms of growth, and if not, why?
Not a replica of 2025 gains. I do see silver reaching, the big number obviously in silver is $100. I do see silver reaching 90, probably averaging 65. That high price is a 26% year-on-year increase. The high price, not just the average. So yes, again, and another year for like strong bull market gains. And we're coming off a very high base, right? Silver can play both sides. I think the big risk to silver is obviously if gold stalls and there's a secular top in gold, and then obviously if we get some sort of real deep demand destruction through a recession. But from a strategic allocation, I think investors are still pretty underweight on silver.
Any commodities that you cover that you are less bullish on, Nikki?
Not in this environment. I think you need to take a step back and we looked at white metals and it's trying to explain what happened in December. It's really simple. We saw gold try 2000 multiple times. It finally broke through 2000. It was a big psychological break in Q1 of 2024 and it hasn't looked back. This is just simply a precious metals re-rating. And silver through 50, platinum through 2000, palladium is probably next to catch up. So I'm relatively more bullish on palladium. And I do think yes, they may have overrun on a fundamentals standpoint, but from a debasement perspective, where we are and we're in wartime economy, you've got highly indebted G10 nations. It's the penny sort of dropping. On a short-term basis, yes, if I have to pick one to be pretty bearish, I think silver, given the index rebalancing, it's got a lot of headwinds to get through in the short term. So yes, I prefer not to buy silver up here, put it that way.
And that begs the interesting question as to what investors may do or should do. I mean, we're not here to give financial advice, but people have been asking me, even on a personal basis, hey, I've been out of the markets and I'm looking to get into the metals, but I'm afraid I kind of missed the rally. And I think my answer is, I guess it depends on time horizon. I don't know how you would answer this question.
Yeah, I think it depends on a lot of factors, your risk appetite, your time horizon. But I think to have some skin in the game, I think there's also various ways to play precious metals or gaining exposure. Obviously, there's physical, there's levered, there's your equities. So I do think just starting by having some skin in the game, 1% is sort of bare minimum. Some of the recommendations up to 5% of a portfolio in precious metals. But there's various ways to get exposure. And I think being savvy on drawdowns on dips. Look, you don't want to chase rallies after silver and platinum have doubled. So I think being a little savvy on dips and sort of a piecemealing into the market, I think is a smart way to do it.
Let's take a look one more time, or actually we haven't talked about this one last metal before we head off now, Nicky.
Yeah.
Copper, also at new all-time highs. And what's the story behind copper? Some have said Dr. Copper, as they call it, has been a good leading indicator for economic growth, signaling where growth is up ahead. Those same very people have been kind of tepid in terms of their predictions on what economic growth may actually be. So I'm getting mixed signals here on what's been driving copper. What's your take?
It's copper is twofold. It's a supply story, a shortened supply story, like every metal, sort of a dearth of capex and supply into the space. Demand is a-okay. It's not great. Demand is okay when you're looking at China GDP sub 5%, US GDP sub 3. Like it's doing okay. The big story and the kicker to copper comes in with tariff uncertainty and Section 232, which is affecting all the other metals as well. So you've got essentially metal locked up in the US, which awaiting sort of the outcome of tariffs and Section 232, which basically that metal's not available for market. So again, it plays the macro lens where it's a reflation debasement trade. And then it's somewhat of a tighter market, and you've got the kicker from tariffs. So copper it's utilized more so than the others in sort of your AR build out in data centers. I think it is Dr. Copper. It can play both metals well, and the attractive thing for copper is it is a deep liquid asset like gold and oil, and so it does attract some of your some more strategic asset managers or pension funds to the space, given it does have the depth that the other metals do not.
Given that all these commodities we talked about are projected to at least maintain their current price levels, if not go much higher, like you said, well, doesn't that portend higher inflation, do you think, globally, Nicky? Are you concerned about that?
Yes, I think generally, if obviously commodities are higher, it will fuel or provide a tailwind to inflation, which is concerning. But again, I think you got to drill down into commodities, and if energy remains sort of lower for longer, I think that can sort of offset that the sort of a negative effect from metals higher. So I think you have this like high for longer metals regime and a low for longer energy regime, which net should at least not provide too much of a scare on the inflation front.
Perfect. Well, Nicky, I appreciate your time. Thanks very much. Where can we
Great, thank
follow
you.
you? Yeah, appreciate it. Where can we follow you? Yes.
MKSPamp.com is our company website, and my Twitter, I'm dealing with that at the moment. So that's all we have for now.
All right. We'll put the link down below so you can follow MKS Pamp there. Thank you once again, Nicky. Happy New Year once more, and we'll see you again soon. Take care for now.
Great. Thanks, David. Have a good one.
Thank you. Thank you for watching. Don't forget to like and subscribe.